Ladies and gentlemen, good day and welcome to L&T Finance Holdings Q1 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. We have with us today Mr. Dinanath Dubhashi, Managing Director and CEO, and other members of the senior management team. Before we proceed, as a standard disclaimer, some of the statements made on today's call may be forward-looking in nature, and a note to that effect is provided in the Q1 results presentation sent out to all of you earlier. I would now like to invite Mr. Dinanath Dubhashi to share his thoughts on the company's performance and the strategy of the company going forward. Thank you, and over to you, sir.
Thank you. Ladies and gentlemen, very good morning and a warm welcome. We have uploaded a presentation I believe is very self-explanatory, but I will still love to take the opportunity of giving some explanations to you. We'll try to be as short as possible. I will talk about this quarter, but more importantly, I will talk about what are the measures we have taken under Lakshya, though quite early now under the next Lakshya 26 plan. It was during the same time last year, in the midst of second wave of COVID actually, that I mentioned to you that our strengths place us quite suitably in the medium to long-term growth after this storm is over. And I believe now the storm is well and truly over. I mean, there are some COVID cases, etc. I always maintained that COVID doesn't affect business so much, but lockdowns do. The way we have vaccinated, the way the country has fought, I think the possibility of new lockdowns is less, and because of that, I believe largely business should be back as usual now. In the last annual investor call and the analyst meet, held during the month of May 22, we shared with you our strategic plan, Lakshya 26, and the underlying goals. Over the last 3 months, these truly have been the driving force for us. In short, the goal is to be a top-class digitally enabled retail finance company. Within this goal, we aim to pivot from a product-focused company to a customer-focused approach, with the aim of creating a fintech at scale. And I have explained what a fintech at scale means last time, and I will also now talk about what we are doing in that direction. Our organization structure has already been aligned to this aim now, changed organization structure. In addition, your feedback after the rollout has been most encouraging, and I thank you for the same, and we have tried to incorporate some of your feedback also as we have gone ahead. I now quickly move on to the highlights of that quarter, this quarter first, the quarter which is just passed. We achieved the highest ever quarterly disbursements, close to rupees 9,000 crores, which is up 10% quarter on quarter, retail disbursements. This is special, really special, because Q4 was highest ever till then. And we have built a 10% growth in disbursement over that also. What is even more special is it is now not driven by just one product. More products are driving this growth. Retail portfolio mix rose to 54% from 45% last year, with about 19% YOY increase in the retail book. The Q1Q book increase in the retail book is also 6%, which actually is quite in line with one of our Lakshya goals, which is a 25% CAGR. So the first quarter itself, we meeting it on top of a good book growth already last quarter, enthuses us quite well. As a part of our fintech at scale, cross-sell and use of data is one of our important aspects. 50% now, 50% of rural business finance and 25% of farmer finance disbursements are now driven by cross-sell efforts of the company using this database. Consumer loans, which is another loyalty cross-sell product, the book has now crossed 3,000 crores this quarter. Coming to NIMs, we actually achieved the highest ever NIMs plus fees at 8.23%, on back of course, quarterly retail disbursement, good quarterly retail disbursements. Interestingly, the quarterly WAC is at a weighted average cost of funds is at an all-time low at 7.27% in a phase of tightening liquidity and increasing interest rates. Now, this is no logic and no magic here. Very clearly, we have been talking last 1 year that we have resisted the temptation of having higher CPs when the interest rates were low. We could have done that and interest cost could have been even lower, but we had locked into substantial amount of medium to long-term funds, which is now coming to our help genuinely. As interest rates increase further, which looks like definitely they will, the weighted average cost will surely increase. There is no doubt about that, but we are confident that the increase will be less than proportionate with the market increase. Also, our pricing power will ensure that we continue to have robust margins as we go ahead. Asset quality has been pretty stable. Reduction in GS3 from 6.67 last year to 4.08 in this Q1, and NS3 at 1.87, PCR at 55. These are the headline numbers. Important to point out, and I will talk a little bit more about this later, these numbers are now on EAD basis. So till last quarter, we have been reporting them on principal outstanding basis. Reason clearly, of course, the numerator, denominator, both were on principal outstanding. Now both are on EAD. The difference is minimal. But there is a difference. There will be a difference. No need to get confused. We didn't want to change suddenly the method of reporting of this in the middle of a plan period. Now that the new plan is starting, we are starting with the method of reporting which is fully in line with the index. Many of you had asked us the question that your GS3 numbers look different in the financial results and in the investor PPT. From now on, it is all going to be absolutely uniform. So there is no need to get confused. It is just a one-time adjustment, and what we have done is last year's also we have adjusted based on this. Our OTR book, I would like to give a little more explanation of the OTR book here. OTR book now stands at close to 2,000 crores from about 3,000 crores just a quarter back. And what is this big reduction of 1,000 crores? We need to explain. Naturally, if you consider the timings of OTR, okay, especially in assets like microloans, two-wheelers, you remember that there was a 6-month moratorium given. So most of the billing actually started somewhere between the first quarter to April, etc. Now, when that happens, if collections don't happen, and we had done some of the collections had actually come in advance, and that reflects in the numbers. But whatever has to roll forward will roll forward either in Q1 or in Q2. And with this, at least on these products, this OTR stuff will be over for once and for all. What will remain is largely after Q2, largely the HL book, where the moratorium was up to 2 years. But this obviously is a very secured book and follows a very different kind of equation. So let me just talk about the numbers. The total reduction of 1,021 crores includes about 548 crores, that is more than 50%, which is closed now. 205 crores written off and 268 crores have rolled over to GS3. So basically written off plus GS3. If you can consider the whole thing as GS3, it adds up to 473 crores, on which a credit cost of 464 crores have been taken. Now, why this? Is the microloans and two-wheeler portfolio which was written off or rolled forward, we have taken a 100% provision. Simple logic that while doing the OTR, these were already DPD accounts, 30, 60 DPD. Now that they have again become 90 DPD, in effect, they are between 150 to 180 days, and we believe it is appropriate that after OTR also, if the customer has not repaid, it is good to do 100% provisioning. a small part of HL portfolio, very small, also rolled forward, which is provided not 100% but accordingly, because it is a very well secured portfolio at LTVs of around 75-80%. But still you will see 464 against 473, a large part has been provided. Important part is out of this 464, there were some questions coming from analysts, so I am going into depths. Out of this 464, 213 have been used from the management overlay. So just for reminder, we had about 1700 crores of management overlays at the beginning of the quarter, out of which 213 crores have been used and 251 crores have actually been used from the P&L, making up the total credit cost of 795 crores. Okay. So in a way, if you see that out of this 795 crores, if we would have used this 251 crores which hit the P&L, we would have used the management overlays for that itself, the credit cost would have been around 540 crores, which we believe can be taken as a sort of steady state credit cost, because I said that most of the OTR, especially micro loans and two-wheelers, which are more vulnerable OTRs, they will be over by Q2. Right? Now within Q2, how much we will take out of management overlays, how much we will hit P&L, etc. Our models and board will decide it, what to take. But largely from Q3 onwards, credit cost will be more on the steady state basis and hopefully continuously reducing as a percentage of the book. So we will come largely out of, we are I believe already out of the woods, but even this OTR stuff will be over by Q2, and after that we will move to more normalized. What gives us also confidence that against this 2000 crores, we continue to carry additional provision of 1450 crores. Okay, in addition to the GS3 and ECL provisions on standard asset. So which in our opinion more than takes care of any further OTR loans rolling forward in Q2 FY23, because out of this 2000 crores now, almost 1000 crores, 900 to 1000 crores is HL. So, that's large, being a large part being HL, we believe that we are not only well provided, we should be able to at the end of the year also maybe still carry some overlay provisions, which we always believe that there is some important to carry some as we go ahead. As we become more and more retail, it is important to carry some as we go ahead. So I hope this clarifies. In our opinion, the OTR book has moved well. We have collected good amounts. Whatever has flown forward doesn't remain hanging. It is provided or written off. We are just getting this over with, and by Q3 return to complete normalcy as far as credit cost is concerned. So that's very clearly the outlook I would like to give. And at the end of all this, even after this, the total credit cost was 12% less than last year. And with that, the profit after tax for the quarter is 262 crores, which is up 47% from last year. Let me now deep dive into these headline numbers. Let me first talk about what I am most happy about, that is retail disbursements. As I mentioned earlier, excuse me, we had the highest ever retail disbursements for the quarter, which were up 10% Q on Q. Strong business momentum has been backed by tremendous amount of digitization and leveraging the power of data, in addition to our inherent strengths in our top three products. Resultantly, the retail book grew by 19% YOY and 6% quarter on quarter, and more importantly, the retail mix is now up to almost 54% from 45% last year and 51% last quarter. We believe, very strongly believe and are confident that by FY23 end, it will cross a minimum of 60% just organically. If like last time we said that if we are able to sell off a part of our real estate book or something like that, it can increase more precipitously, but just organically, the way real estate book we are collecting and the retail we are growing, this will touch a minimum of 60% by FY23. and itself, and to know that our Lakshya target in FY26 is a minimum of 80%. So all is going well. We are not only dependent here on the environment to carry us, but we are using new products, we are using data analytics to drive this engine. As our two, let me talk about the environment for a minute. As two of our large businesses, which is rural business finance, which was erstwhile microloans, and farmer finance, these are rural based. Let me provide you some color on the progression of monsoons and its impact on rural incomes. There is a lot of commentary. Let me give our house view. The southwest monsoon's revival in July, after a relatively dry June, has led to the area sown under Kharif crops exceeding last year's level already now. For the first time now in the current planting season, till about a few days back, it was negative from last year. It has now moved to positive from last year. On a cumulative basis, the country has now received 353.7 mm rainfall, which is 13% above normal. And it is compared to 5% above normal just a week back. So it's really catching up. Week ending July 13th was actually the rainiest week of the season. Now nearly 53% of the country has received normal rainfall. Amongst major agrarian states, only Uttar Pradesh is a little worrying, which has reported large rainfall deficiency in nearly 29% of the total districts. So that's a little worrying, but overall, everywhere else, rainfall has caught up very nicely. Even more important than rainfall, reservoir levels. Reservoir levels throughout the country have improved significantly over the previous week and now are up 23% year-on-year basis. This bodes extremely well for the coming crop season. Also, the second thing that we look for, third actually, rainfall one, reservoir levels, third is acreage. The Kharif crop acreage has already surpassed last year's level, with paddy being the only concern due to less rainfall in UP. Very clear, correspondence there. The mandi arrivals and prices of major rabi crops have stayed extremely robust, and many states like Maharashtra, AP, Haryana, Telangana are taking further farmer measures, and we believe that cash flows in hands of the farmers are going to be extremely good, and we are quite hopeful of a good season in rural India this year. According to a study by ICAR, I'm just quoting the external agency, farmer incomes across states have now increased between 125 to 270% in FY21 compared to FY17. So little aged data, but it's good, directionally good. All this bodes very well for the cash flows and repayment ability of our borrowers, especially in rural India. And this really shows the revival of the rural economy after COVID had begun. So now let me talk business by business, rural business finance, which was previously known as microloans, and I will just explain that. Our strengths in this segment are slowly coming to fore. Subsequent to the master directions issued by the regulator for microloans, microfinance loans, we very swiftly modified and launched our sourcing digital app. In fact, on 1st of April, we were in the market with the digital app. The need for this app, of course, internal needs of changing of processes, making everything paperless was there. But one most important thing was calculation of household income. Now, any of you who would be interested in having site visits, etc., you can contact our IR. But I would really invite you to come and see the way this app operates. The calculation of income doesn't happen by asking the people what is your income, but it happens by surrogates. You ask how many cows you have, or etc., and income is captured. Collection is captured there. The geotagging of customers is there. Route maps are on that app. So it's a really state-of-the-art app. Still developing, but already a fantastic app. We would love to demonstrate to any one of you. The important part is based on this information gathered in this quarter, it is actually seen, and we always sort of knew this, but we didn't have proper data, that only about 17% of the new business sourced during the quarter qualifies as microfinance, meaning family income less than 3 lakhs, which means that remaining 83% is money given to comparatively higher income groups, that is household income more than 3 lakhs, where lending can happen using very advanced credit metrics, which opens up tremendous opportunities for growth there at very good credit profile and credit costs. Putting all this now against a run rate of say about 1,000 crores in the second half of last year, we are now stabilizing a run rate of about 1,200 crores per month disbursements. This has been undertaken by one geo expansion while continuing to maintain the same stringent credit conditions for the business, which bodes well for sustained profitability, asset quality, and book growth. We are looking now for new product launches because as 83% of the disbursements are in a better income profile, new product launches both in secured and unsecured category in this segment. The pilot for the same will be initiated by Q3 maximum. The book of rural business finance stood at about 14,400 crores, up 27% YOY. Let me talk about farmer finance, which is admittedly still predominantly tractor finance, either new or what we call Kisan Suvidha, which is cross-selling to our existing customers. We have maintained our market share here in this segment and continue to be market leaders, albeit the number 2 and number 3 have seriously reduced the gap, no doubt, but we continue to be market leaders as of end of June. And in any case, I always say market leadership doesn't depend on whether you're number 1 or number 2. It depends on whether you make market practices, and we genuinely believe that we make market practices. When I last spoke to you, I had mentioned that we are seeing early signs of recovery in the rural segment. This quarter, we have financed actually our highest ever number of tractors, which was close to 33,000 units. While continuing to dominate the farm equipment finance business through focus on higher counter shares with preferred dealers, we are now also preparing to pilot launch our warehouse finance business this year, which is in alignment with our Lakshya 26 goals to move towards a more consumer-focused approach. So, having an excellent farmer database, funding his warehouse finance requirements now will be the next product after new tractor finance and Kisan Suvidha. Let me now talk about urban finance, and actually, maybe first time we are talking specifically about urban finance. This has 3 products, that is two-wheelers, which was an existing product, consumer loans, which is a mainly loyalty product as of now, though we have now started doing outside business quite well, and home loans LAP. This total business saw growth of about 138% YOY in disbursements and 15% jump quarter on quarter. Talking about two-wheelers, it was an 84% jump in YOY jump, but that's okay because last year, same quarter was COVID quarter. But this is the highest ever Q1 disbursements. That is important, with over 1.9 lakh units funded during this quarter, where the emphasis has been on deepening our geo presence. We continue to work on focused OEMs and dealer strategy to maintain our market share. Consumer loans is our first digital native product, which is an entirely digital proposition, no touch sourcing, instant decisioning, end-to-end no touch, no documentation, nothing, and is very close to my heart. We started this business on cross-sell to our existing two-wheeler customers. Now from 400 crores of disbursement in the whole of FY21, just less than 2 years back, we have registered 1,000 crore disbursement in Q1 itself. While maintaining and how safe the book is, we have started giving our early bucket, zero bucket collection efficiencies already, and on-time collection efficiencies and you can see where these numbers are. This is absolutely boding well for the momentum of this business. We are now also growing this business by offering products through various partnerships. Top-ups, cross-sell of products to these set of customers will further enhance the offering to our customers. Retail housing, this is interesting. This is another business which has the full potential of becoming a game changer for us. And I have always said that we had not done great in this business till about 9 months back. I am truly excited to see this happening slowly now. During the last couple of quarters, focus was quite clearly on rehashing our approach towards this business, getting our market offerings right. I believe we are progressing steadily on this path with disbursement touching 936 crores in Q1 as against 306 crores last year same quarter. The business trajectory is having a steady upswing for the last 4 quarters. During the waves of pandemic, we are concentrated here mainly on salary. We have now started picking up disbursement on the ACMP segment, LAP offering, which will now make this product relatively profitable also. And last time I had explained also that it is not just for profitability that we do this business. Our major growth is also happening through unsecured products like rural business finance, consumer loans. It is important to grow the secured book for various other purposes, for regulatory purposes, for credit rating agencies. If you put this whole basket together, the profit growth is going to be quite good. And that is why we have confidently said that ROAs will reach 3% by the end of the plan period. Before we move further, I would just like to share a small update on our SME business, where we have completed our pilot and will be going for an open market expansion in the next couple of quarters. Pilot was undertaken in just 2 cities, Mumbai and Pune, with the aim of delivering a value-added digital proposition. Over the course of the last 9 months, we have built a small book, but a strong offering, and now we are ready to hit the market running. So you will see this now, if not so much in Q2, but definitely in Q3, we will start showing the numbers. On the collection side, our continued focus on analytics and data-driven resource allocation techniques over the years ensured that the collection rhythm remained robust across businesses during the quarter. Our collection efficiencies continue to do better than industry peers, and this has been made possible owing to a concerted on-field efforts and analytics-led prioritization and rural and resource allocation. Portfolio focus continues towards boosting zero DPD collection and managing early bucket delinquencies. We have actually started reporting now the zero bucket collection efficiencies, and we have reported it for the past almost 15 months, so product by product. This was also your feedback, and we have started reporting. And I believe that NPA control is very important, no doubt, but much more important is the zero bucket collections. It happens at the minimum cost, mostly hopefully at zero cost, and that avoids the headaches for the collection team as it goes ahead. So I will not repeat the collection efficiencies in all the products. It is very clearly given in the presentation, but I can only say that all of them on due date collections are back to pre-COVID levels, and in some products actually better than pre-COVID levels. So we are doing well there, which bodes well, and which bodes also gives us the confidence to give you confidence statements like Q3 onwards credit cost will be normalized and reducing, etc. On wholesale finance, in line with Lakshya, let me just remind you, we had said 2 things. That real estate portfolio, we have stopped disbursing anything new. We are concentrating on completing projects and repayments, and if possible, we will look at some structures where we will be able to sell off a large part of the portfolio. We have not been able to do that, at least this quarter, but early days. But we have been able to get good repayments from projects, close some projects and get good repayments. So that part has worked. The inorganic part has not worked, let me say so. On the infra side, we also said that we are, of course, running our normal capital light model, but we may also look for some partners in this platform. This platform is very valuable. That process is also on. 1 quarter is too early for anything to happen there, but we will report to you as we go ahead. In the meanwhile, wholesale book disbursements was muted at 1522 as we are maintaining capital a capital light model, and the wholesale book registered a reduction of close to 6,000 crores, a degrowth of 13%. Real estate especially, we continue to stay away from looking at any new projects and continue to concentrate on existing project collection with the objective of exposure reduction. We are quite happy that the execution of this strategy resulted in a reduction of the RE book by 2,563 crores YOY and by 1,400 crores Q&Q. Now, we have also given at some point of time numbers like 4,000 crores that we have collected. So now why book has not reduced by that much and only by 2,500 crores? Naturally, 1,400 crores motamoti has to be spent in completing those projects. So it's little bit of disbursement for completing those projects and then collection, and then this is the net reduction in, but it is going well now. This book is already less than 10,000 crores. It's 9,800 or something like that. Okay. On investment management, last but not the least, market was negative, both debt market plus, but also equity market. But still, our Q1 AUM at the average is little bit about 70,000 crores now. The transaction is going on well. The integration efforts are going on well. We are waiting for the last regulatory approvals and hoping to conclude that transaction in Q3. So that's completes comments on business. Liabilities, as I said, working capital, the WAC, weighted average cost, all-time low, very clearly based on our ability to raise long-term and medium-term funds last year. At this point to highlight is even in Q1, we raised long-term funds of close to 1,100 crores in Q1, while keeping the average CP proportion at just around 11%. Now this holds us in good stead. Going ahead, as growth happens, we can actually fund it, and growth is majorly happening in retail, which will be shorter term. We can raise shorter term resources, we can increase CP proportions, and we are quite sure that our cost of funds hence will rise, definitely rise, no doubt, but rise much lower than the market cost of funds. NIMs plus fees also will be maintained because of our ability to pass on the fees. NIMs plus fees may reduce. I think by the end of Q4, I may guide maybe maximum 8% will be, up to 8% will be the reduction. We don't see NIMs plus fees falling much lower than 8% by the end of the year, which is 8.27 now, 8.23 or something like that. Yeah. Okay. One more fact is that our, the ex-IDF, after 1 year, WAIT got the NBFC ICC license. We were able to transfer some of the assets from L&T Finance to that entity, thus reducing the negative carry. So you would see now reduction of the liquid cash that we are carrying, and hence a good reduction in negative carry, which will also reduce the cost of funds as we go ahead. Asset quality, GS3 stood at 4.08 and NS3 at 1.87, which is an improvement year on year, fairly steady quarter on quarter. I have already mentioned here that I have already given explanation that these are on EAD basis. So please don't try to compare it with the number in the last investor presentation. We have given past numbers. Anybody who wants any other past numbers for any other quarters, etc., IR will try and give it to you. Just any clarifications if you need, you can ask on this call or to IR. This is quite clear, and now from now on, it will be on EAD basis. Capital adequacy quite adequate at 23.12, in fact quite high. As we grow, we believe that it should trend downwards, and hence will be good for ROEs as we go ahead. So yeah, in summary, PAT up 262 crores, up 47%. Back on increase in income and reduction in credit cost, and we believe that this trend will continue well and will accelerate from Q3 onwards. Hopefully, by FY24, we will be at profitability levels which you have been more used to before this nightmare of COVID and everything started. So that's where we are moving. Okay. Having spoken about this quarter, now I know I have spoken perhaps a bit too much. I thought first quarter of Lakshya, maybe I was also a little bit more excited. But let me give you a brief about the progress of Lakshya 26 plans. Early days, just first quarter, but still, I'd like to talk a little bit more. If you remember, there were 4 pillars of the plan: sustained profit and growth engine, demonstrable strengths in risk management, creating a fintech at scale, and sustainable future growth through ESG. Now, as a part of creating a sustained profit and growth engine, we have now unveiled a new organization structure which is totally customer-centric. So we have now, in retail, we have 2 businesses which are rural, 2 businesses which are urban. Rural business, which is now the rural business finance verticals, which takes care of small businesses within rural, which was erstwhile microloans. This will not be limited to current product suite, but as I said, we will keep adding new secured and unsecured products to the basket. Rural individuals, farmer finance vertical will now offer not only farm equipment loans, but also warehouse finance and other agri-allied loans. Coming to urban consumers, our present offerings are two-wheeler, CL, HL LAP, which are now all of them. Two-wheeler, of course, we are in the top 5, but CL and HL LAP are getting well established. Additional volumes are being targeted, and geo expansion is also being targeted. Cross-sell is being targeted. So this is how we will grow our urban finance. And then urban small businesses, which is SME, where we are babies. The lots of disadvantage of being babies, but a big advantage. Number 1, the market is large, huge. There is business to be done. Number 2, we have learned from people's mistakes, launching state-of-art digital product to start with, and hopefully will make a mark on the market in the couple of years going ahead. So these are the 4 verticals. Out of these 4 retail lending verticals, 3 are headed by chief executives who are our internal talent. So 3 of them we were able to find people from inside, internal talents, and for urban finance we have hired a top talent from one of the leading private sector banks in mortgages. So very, very clearly the business organization in retail now well in place, 1 level below them, the regional structure, zonal structure well in place, 4 strong chief executives looking after each of these businesses, running almost like separate companies with common functions like HR, finance, audit, risk, etc. common. So that's the way the organization has been realigned. In addition to the realignment of the organization, we continue to work on building major strengths across businesses, including deepening of geo network and data mining for cross-sell. On the risk side, we continue to build strengths in risk management, and our sustained collection performance across products, which is well above industry performance, is a testimony to this strong portfolio. And we are actually looking at how new age risk management practices can be more and more adopted. On the digital side, as we build digital channel for expansion, we are also focusing to upgrade our information security management systems. Our systems are now ISO 27000 compliant, and we will continue to build strength against possible cyber threats. Third pillar, fintech at scale, which involves 2 distinct vectors. 1, expansion of digital channels, and 2nd, leveraging of customer data for cross-sell. During the last quarter, 50% of our disbursements in rural business finance and 27% of disbursement in farmer finance are based on cross-sell. The company is actively working towards monetization of its 7 crores plus customer database, including existing and past borrowers, co-borrowers, guarantors, prospects, and references to enhance this cross-sell reach. In terms of digital channel expansion, I will talk about 2 initiatives which I have talked a little bit about 3 months back, but I will give you the progress. Our Planet app, our customer-facing app, Planet, was soft launch in Q4, and within 1 quarter has shown 2 lakh downloads. The application, which currently provides onboarding and servicing options for customers, is available both on App Store and Play Store. This app will provide us with geo-agnostic servicing and sourcing channel, trending quite well. WhatsApp for Business, that I had unveiled and showed you the WhatsApp bot, which was for servicing. We have now expanded that the WhatsApp channel is now open to consumer loans customers for booking loans, and people can apply for loans anywhere between 50,000 to 5 lakhs there, and we are maintaining a complete end-to-end turnaround time of 15 minutes for that, credit to your account within 15 minutes. So these two developments. I would like to talk a little bit on the servicing side. Just 1 year back, our servicing pyramid was branch heavy with 51% requests coming in branches, and which is a disaster. I mean, obviously, with 1,600 microfinance touch points, more than 200 branches, it is impossible to train and retain service executives to give uniform service. We have now inverted this pyramid and already become a very digital channel or self-help channel heavy. Almost 58% of requests were serviced through the digital channels by June 22, and only 21% now are coming from branches, and we will try and reduce it further. So both on sales side and servicing side, digital initiatives are working well. ESG initiatives, which is the fourth pillar, within that we have published our first integrated report for FY22, which is in compliance with reporting for all essential indicators under BRSR. It is audited by an external agency, and we have published it 1 year in advance of its applicability. Our water neutrality status has been assured by independent assurance provider, and we have adopted 22 sustainability targets for FY23. We have achieved water neutrality in FY22 and will aim to be water positive in FY23. More importantly, a small sustainability linked loan also has been raised, very small, no doubt, just 200 crores, where the interest rate is low and will keep reducing as we achieve more ESG targets. And as in FY23, we have taken a target for a higher amount of raising this. So ESG is great for the planet, great for environment, but we believe it will also be good for business and hence very sustainable in the organization. So that's about it. I will just say that the initiatives we have taken in the quarter are just a few early deliveries of the plethora of projects going on to become a strong retail finance company. I'm sure as quarters go, we will be able to show you enhanced performance and unveil further projects and consumer offerings that we have in pipeline. As far as financial performance goes, Q1 has been extremely good for disbursement, collection, credit cost, profitability, but we humbly acknowledge that this is just one quarter out of 16 quarters included in the Lakshya plan. So one swallow doesn't make a spring, but we definitely believe that it signifies a good beginning towards our Lakshya goals of 80% retail book, 25% CAGR of retail book, NS3 of less than 1%, and ROA between 2.8 to 3%. Thanks a lot. I realize that I have spoken quite a lot, 45 minutes. Apologize for that, but hopefully I have already answered some of your questions. We are open to questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Rikin Shah from Credit Suisse. Please go ahead.
Hi, good morning. Thank you for the update and the opportunity. I have 4 questions. Firstly, led by the retail disbursements, we noticed that NIMs plus fees is at 8.25%. But if you look at the yields in the retail portfolio, they have come off by 50 basis points. And as you scale up your home loan lab business, how should one think about them directionally? Of course, the fee income has also gone up. So could you talk a bit more about any incremental fee that you are seeing from the cross-sell opportunity? That's the first one. Second one is on the acquired portfolio. Could you throw some light on the nature of acquisition of the portfolio? What kind of loans have been acquired and the plans to how big this can get? Thirdly, on the restructured book of the remaining 2,000 crores, 1,000 crores you did mention are pertaining to retail home loans. What would be the split between the remaining 1,000 crores? And what would be the overall provision coverage on the 2,000 crore restructured book? And the last question is relating to the news reports of selling of certain accounts of 80 crores to an ARC. What would be the recoveries and any potential write-downs or write-backs, if at all, that would happen? These are the 4 questions. Thank you.
Okay. So I'll try and remember the 4 questions. The first was on yields, right?
Retail yield.
The first was on retail yields, right? Okay. So again, good morning, first of all, and thank you for your questions. So, okay, retail yields, number one, as you know, it is a part of, I will answer you strategically as well as tactically. Tactically, some of the reduction that you see is when the OTR book flows to GS3 or is written off, the income is taken out, de-recognized from zero DPD onwards. So in the quarter that it happens, it goes not from the credit cost line, it goes from the income line. So as I said, in Q1 and Q2, this all will be over, and after that, things will come back to normal. So this small reduction, don't read too much into it. It's we are, in fact, I already said that NIMs may contract a little bit. That is not so much because of HL/LAP, because HL/LAP will grow, but the other products are also growing much. It is mainly NIMs will contract because our major product is the rural business finance, which we charge 24%. Now, even if the cost of funds go up a little bit, if it goes up by say 50 basis points or 60 basis points, we are not going to increase that 24% to 24.5. So very clearly, we believe that 24% is a good, fair rate for those customers, and we will clearly keep it there. Okay. Any small changes quarter on quarter. So this is, both tactical. The first part was tactical. Strategic, our product mix will make sure that our NIMs plus fees maintain at a decent level. I said this year we don't expect it to come down below 8%. Yeah. And that too, I'm also taking into account mutual fund going out in the last quarter. So some fees will go out from there. Even then, we are confident around 8%. I mean, if it becomes 7.9, don't hang me, but that's the indication. It's around that it will grow. So also sometimes tactically, when competition hots up or something, you do tactically take some reductions, 10 basis points, 25 basis points, to maintain your positions in some market. So it's a mix of all these things. If I were you, I wouldn't read. There is no directional reading in that. We will be able to maintain overall retail yields quite healthy. So that you can take from me. Second question, OTR. Okay. OTR, what remains, as I told you, close to 1,000 crores is HL/LAP. Around 75% of the rest is microloans. And this whole thing, what is remaining in microloans, will be over in Q2. So either we will collect a lot, or whatever doesn't get collected will flow, and we will either provide it 100% or write it off. As you know, against this 2,000 crores and 240 crores is one ILFS account, which is about 240 crores, which is done OTR, and that's green, right, after OTR. So OTR done, but green, and that money will come back. So that's not an issue. So out of this 2,000 crores, almost 1,800 crores is retail, 1,750 is retail. 1,750 में से 1,000 crore HL, 750 around 600-700 crores is microloan. So I'll give that. HL will remain till next year, large part of it, but that is secured. So we expect a large part of that money to be recovered. If it flows, we will start providing the way our model tells. I think first we provide close to 6-15% and then keep increasing based on various movements in the portfolio. Microloans, whatever becomes 91, we will provide 100%. So that's very clear. We carry adequate provisions in that. So you talked about OTR provision. So now I will be technically right. OTR provision will always be only 10% because RBI asks 10% to be provided. But what we have done is have other provisions, management overlays. And as you know, 1,400 crores are being carried today against almost 1,750 crores of retail, out of which close to 1,000 crores is HL left, so it is not going to require. So if you see, let's say worst case scenario, say 60, 70, 80% of microloans roll forward, we are more than adequately covered. So we are very sanguine on that. And most importantly, this will be over by Q2. So after Q3, other than home loans, no OTR remaining. That was the second question. Now you have to genuinely remind me of the third one.
Acquired portfolio.
Acquired portfolio. Small acquired portfolio, we had mentioned last time that we are targeting, say, around 1,000 crores or so in this year of acquiring portfolios from other good NBFCs or sometimes some fintechs. We, of course, go and examine this portfolio, but there is enough over-collateralization that we buy it. Very small transactions have happened now. There is significant amount of credit enhancement on both these transactions. It is largely done not as a big strategy, but you know that we are also required to use our capital in retail. So just as an experiment, first year, close to 1,000 crores we will do. Excellent NBFCs, good credit enhancements, and we will see then how it works and how it moves. So that's, and it's entirely retail, of course. It's entirely retail. I will tell you, part is two-wheelers, part is personal loans. Okay, fourth question.
Yes.
ARC. ARC is, there are assets which are NPA wholesale assets, and in the, reducing wholesale portfolio, sometimes we do that. This time, out of that number you mentioned, some 1,000 crores or so, a large part is a completed commercial park in, let me not tell you the city, then otherwise I will be just almost accurate in saying this. It's a completed commercial park. There are some difficulties in selling it on a timely basis and getting the money back immediately, but it is completed and a few more moments it will be done. Well provided, we always provide first, sell it at the carrying cost after the provision, and hence any immediate reduction in value is unlikely. We have sold some in the past also. As these are examined by external credit rating agency, external valuers, it is valued, we keep taking those costs, and it is a part of our credit cost that you see. Does that answer your question?
Yes, sir, it does. Thank you so much.
Thank you, Ricky.
Thank you. The next question is from the line of Hardik from Goldman Sachs. Please go ahead.
Yes, Hardik, tell me.
Yeah, hi, Mr. Dubashi. This is Rahul here.
Hi, Rahul. How are you?
Good, sir. Good. Thank you so much for your time today. Just two questions, sir. Number one, on the provisioning. Of course, we did appreciate that you've taken some extra provisioning this quarter, but given that you already are having a large macro-prudential provision, and of course the credit environment seems to have gotten better with collection efficiency improving across the board, why are we sort of still onboarding or maybe making an additional provision? What exactly is the philosophy? And I did hear your remark to the previous question about the OTR almost getting provided for maybe in the next quarter or so, but just sort of a bit perplexed, why do we sort of keep making these extra provisions, sir? When do we normalize?
Okay. So Rahul, thank you for the question. So technically we have not made any more provisions. In fact, 1,700 has reduced to around 1,400, right? So we have actually utilized. I believe what you meant was why this entire 473 crores was not taken out of those management overlays and why P&L was hit at all, right? That is your question. It's a matter of two things. The board and the management, one, needs to be confident when we release this. That is how this is meant for the rainy day. We will keep reducing this management overlays as we go ahead, no doubt. Also remember always that it is always, the way we started making this macroprudential provision, we all tend to forget this. We started making this macroprudential provision well before COVID hit as a good practice in business, because as retail increases, as sort of unsecured loans in the balance sheet increases, it is good to carry a buffer so that we don't hit P&L with shocks anytime. Now there is it is basically can be called counter-cyclical provisions as well. Now it's a call that the board will take that out of this 1700, how much we can use the whole thing and the P&L will look fantastic this year itself, naturally, I mean, very simple. You do a simple calculation that we have reported 262 crores. If you take out, if this 251, right? Yeah. 251 would have been taken out of these reserves and not hit the P&L, profit would have gone up by 75% of that 251. So it would have been close to 450 or 425 or something like that, technically, right? So it would have been a fantastic number. But perhaps that would have led to, and I don't know, I'm not clairvoyant, but that would have led to complete depletion of these reserves by the time this year is over, once all the OTR is over and everything. I believe, and we all believe, the board believes, that having built this 1700 crores, we should not utilize all of them and keep some part of it as counter-cyclical, and once create when able, as when the P&L actually returns to very healthy level, not now, say in 2 or 3 years, actually start keeping something aside as counter-cyclical provisions even after that. So it's a measure of conservatism and nothing else. So we have not created anything new. There is no intent of creating anything new. Clearly intent is, of course, using what we have created. The question is, it is a matter of opinion whether we should use the entire 1700 or use a part of that. At this point of time, we believe that in this year, we will use a part of that because HL, even though we don't see any big problem because of the security levels, OTR will come next year. But even more importantly, there we don't expect much losses. More importantly, the book has micro loans, the book has consumer loans. It is good to carry counter-cyclical reserves always. That's our opinion, and a substantial part of this remaining 1400 crores we will carry forward next year also. The important part to remember is all this will get over in Q2 and Q3 onwards. The credit costs that you see are clearly normalized credit costs.
Understood. Appreciate the response, sir. Maybe, just one more, follow on, with regards to this and plus the capital gains that you will get from the, AMC sale to HSBC. What do we intend to do with that, gains, and have you thought about it? Will that be used for, again, some provisioning, or will it be passed on to the shareholders? How do you plan to use that?
Above my pay grade, buddy, to answer this. The call will be taken at the board level, but it will be a mix of all those things. It will be we would believe that we will look at, subject to regulations, etc. We will look at passing on some of those gains to shareholders, certainly. Some of them we may keep as reserves for future, because we are looking at reducing strongly our real estate book. So maybe for that effort, we will keep some. So it will all in some terms of might not for specific projects, we may keep some. So really, the call will be taken in Q3. I must also say on the positive side, there are some opportunities opening up for acquisitions. With valuations coming to decent level, there are opportunities opening up, good portfolios, good companies for acquisition. You know, we have been very conservative. We will not do anything silly. But if a good opportunity comes, that capital will also be used for that.
Fair enough. Just one last question, sir. In terms of the normalized levels of loan book, of course, you are paring down the real estate portfolio, etc. So wholesale is becoming or has always been light, capital light kind of model you followed. When do we start seeing the normalized, levels of, loan book in the next, few quarters? By when do you intend to?
Growth in overall book, I think, for onwards, FY24 onwards, you will start seeing a growth in overall book. But this year, my suggestion is concentrate on the growth in retail book, because while the overall book is not growing, the composition is changing tremendously, and which will lead to increased profitability, definitely. But whatever we are doing with the real estate book, etc., large amount of reduction will happen this year, and growth in overall, we are expecting real estate book to even come down by 50% from here during this year. So, growth in overall books perhaps from FY24. And now you are seeing that even the old defocus book is down to just about 400 or less than 500 crores. So all those things are over, and the retail growth will take over. It's just arithmetic, the matter of time.
So this year ROAs will improve, and next year the growth, etc., will improve. So leverage.
We really believe, yes. And ROAs will keep improving. Next.
Thank you so much, sir. Thank you so much, and good luck.
Thank you.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yes, sir. Thanks for taking my question.
Hi, Abhijit.
Hi, sir. So firstly, on the rural business finance, I think during the opening remark as well as in the press release, we have said just about 17% of the disbursements in the quarter qualified for microfinance as per new RBI guidelines. Just wanted to understand, what was the mix like before these guidelines? Basically, were we largely present in the customer segment where the household income was greater than 3 lakhs? What was the mix like before that? Why I'm trying to kind of understand this is, despite having exposure to customers where the household income is greater than 3 lakhs and, like you suggested, better credit quality customers, despite that, we've seen significantly high OTRs and credit costs in the rural business finance.
OTR happened before the guidelines, huh? So we don't know. See, the OTR happened before the guidelines came, right? So we were not measuring household income before that. So I won't be able to answer your question. That time, even in the individual income was not being measured by anybody. That requirement was not there. It was a declaration taken that individual income is less than or more than by 1.5 lakh. 1.5 lakh. Our customers, we believed was individual income was always more than 1.5 lakh, and that's why you remember we changed the questioning from microfinance to micro loans, because we were not sure that our customers' individual income is less than 1.5 lakh. So we didn't want to take any regulatory risk by calling it microfinance and being not able to prove that these are qualifying assets to RBI. So we were just safe there. The family income of 3 lakhs has started measuring only from 1st April onwards. So it may not be right to compare how much OTR, etc., etc. And after all, again, when the government was allowing OTR as a right to every citizen of the country, by the way, it was not that much of a choice. If somebody asked for OTR, largely, unless or until that person is proven to be a defaulter everywhere, you have to give OTR. So with people asking like that, what total microfinance OTR we had done was 900 crores or so on a portfolio of close to 12,000-13,000 crores. Even that was not out of line at all with the industry. In fact, much better than the industry. So, your question had two parts. I have tried to answer it this way. But don't link this 3 lakhs and more than 3 lakhs to OTR, because they were not happening at the same time. OTR happened last year. Measurement of family income has started from 1st April. That is why even if you see in our investor presentation, this differentiation between microfinance and rural business loan, we have given only in disbursement, not in book, because book का data है नहीं हमारे पास.
Okay, got it. So second question I have is, I think during your opening remarks and to a couple of participants in the call earlier, you suggested that you expect credit costs to normalize from 3Q onwards. And somewhere I heard that we expect steady state credit costs of about what we saw in this quarter, which is about 500 to 550 crores on a quarterly basis. So
I wouldn't like to do your job here. What I said was little different. I said this OTR will be over by Q2 and hence normalized credit cost will be there from Q3, right? 550 crores this year, I just clarified that out of 795, 251 is OTR related, and then normalized credit cost for this quarter is 550 crores. That doesn't mean Q3 onwards it will be 550. We actually hope that it will be lower, but still that's your job to judge, no? मैं थोड़ी तुमको Q3 का credit cost बोलने वाला हूँ.
Got it. And sir, lastly, this retail business that you are building and even under Russia that we kind of plan to take it to 80% by FY26. What is the steady state credit cost that you are expecting from this business?
Yeah, it will be product wise, depending on product mix. You want to work on your models, any help you need, you contact IR. I think let it suffice to say that we are looking at ROAs of 3% in 4 years, very steadily increasing. Okay. So as Rahul summarized it very beautifully, ROAs will grow up this year. Next year growth will also come and ROA will also grow, thus increasing ROEs. So and ROA should reach about 3% by FY26. Steady state credit cost, etc. will differ product wise. You will have your own judgment of how each product will grow. But any thoughts you want to reflect of our IR, you are welcome.
Got it. And so lastly, data keeping question. What is the gross stage 3 and net stage 3 in your real estate wholesale book and the infrastructure finance business?
We have given the wholesale separately. No? So overall retail and overall wholesale we have given. But okay, to tell you, ऐसा कुछ major difference नहीं है. Real estate one big NPA which we have told. So that 1300 crores you remove and you actually see that hardly any NPAs after that. Okay. Last year we already said, no, one big NPA in real estate.
Got it. And so this media article which was there about the sale to Phoenix ARC, is it already kind of reflecting in the numbers that you have reported, or will it reflect in the next quarter?
I don't know about the media article, but I clarified in my in the question previously that it is reflecting. The media article may have some numbers which I don't remember, but the actual number is 1,000 something, 1052 crores. That is reported.
Thank you so much, sir.
Yeah.
This is very useful.
Good. Thank you.
All the very best.
Thank you. Next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Hi Kunal, कैसा है?
Yeah, hi sir. Good. Sir, so firstly, in terms of if you can just broadly explain the 750 crores of micro loans which are there in restructure, if you can give some flavor in terms of how much are paying, how much are part paying, and how is the behavior currently, just to gauge in terms of how much could really slip and what can get into 91 plus DPD.
Oh.
So maybe that would be helpful in terms of the trend, because this time there was something which has flown in. So maybe that would be helpful if you can just give the behavior of that particular portfolio. Yeah.
That's what I will do rather than that. 300 crore से कम हुआ है in March to June. OTR. I will give you a breakup of that. Will that give the trend? In March,
300 crores?
March to June, micro loans OTR has reduced by 300 crores. Okay?
Okay. And
out of which around, I would say 75% was movement to GS3 and 75% was resolved and closed. 25% was resolved and closed. 75% moved to GS3. out of the 300 crores and we provided for. So even if the same trend continues, we believe that the trend should be better because more collections are happening. But even if the same trend continues, that is what I said in my remarks, we are well and properly covered for that through our macro bridge.
Sure. So 75 crores was something which was recovered from March to June, and maybe 225 crores would have actually slipped into GS3 from microloans.
But let's say 70-75% moved and the rest was recovered.
Yeah. Okay. Got it. So broadly then, and maybe you said whatever would be 91 DPD, we will write it off and provide it entirely. So that would be the stance in Q2.
Write-off is a more tax-related decision, but provide certainly 100%.
Got it.
Yeah.
Sure. And again, in terms of the inorganic opportunity and capital allocation, if you can just highlight that in terms of what is the extent of capital allocation which we can look towards the inorganic opportunity, something if it is there in the mind, and particular areas, or maybe the product segments where we would tend to prioritize it. No doubt that there would be various opportunities across the product segments.
You get me into trouble. I can't answer this on a call or anywhere. Opportunities keep coming. We will have a look at it and the board will take a call. The most important thing, हमारा मराठी में एक saying है कि वो पैसा आने के पहले गिनना नहीं चाहिए. So there is money still to come. That is in Q3. There is a SEBI permission which is required. I can't take all these things for granted. So hopefully all that.
Overall, in terms of capital allocation, would there be anything which would be towards the inorganic opportunity, given that book would be running down? Yeah. So
book running down? No. I mean, very simply, retail book is growing. So there is no question of book running down. Right? Retail book is growing rapidly. 25% CAGR is what we are planning. I mean, उसको running down नहीं बोल सकते ना. So book is growing continuously. Wholesale is reducing, especially real estate will reduce. If we are able to sell a majority in the infra platform, if that happens, then yes, then the overall wholesale book will reduce precipitously. At least if we own less than 50%, then it won't be consolidated. At that point of time, of course, we will have to think of acquisitions more seriously, perhaps. I am using the word seriously, not aggressively. We never look at acquisitions aggressively. But it is all still to happen. First, mutual fund money has to come. Then we have to reach some level of discussion, success at least in this, getting a partner in the infra business. So at this point of time, if I go to the board, they will say, okay, at least show me an opportunity, at least show me this money. Why are you having this kind of plans? But what I am saying right now is simple small portfolio buys is what we will do on a very trial basis. We have put a small budget of about 1,000 crores for this year. We may do little less than that, little more than that perhaps, but those are portfolio buys for which it is not a big opportunity for which I need to be sure of anything, go to the board, etc. So that will happen. Any large opportunity is a question of the opportunity. More importantly is the question of the value. No? So too early to answer that question. Capital allocation, organic capital allocation, very clear, increasing to retail, going to minimum 80%. And if we can reduce real estate more precipitously and get a majority partner in the infra platform, even more than 80%. So that will be the capital allocation.
Sure. And lastly, in terms of fee income, so the sequential jump and the overall jump which has been there. So obviously some would be volume related, wherein there was almost like 10% sequential increase as well in the disbursements. But what would be the other component? Because I thought maybe overall, when we look at it in terms of the AMC fee also, it would come off a bit. But I think the traction is strong, and do we expect it to sustain over the period? Maybe 200 odd crores fee and other income in retail finance, a quarter.
Certainly expected to. It is very much business related. Certainly expected to sustain. It is also cross-selling related. The protection products that we sell, it protects our portfolio also, and it gets us income also. So that's working extremely well. and it will keep coming on.
Linked directly to business.
Directly linked to business. In fact, we used to get the other income we used to keep here, right? I mean, what about the interest earned on surpluses? In fact, interest earned on surpluses was a part of this. Now those surpluses are coming down, but in spite of that, this portion has gone up. So it is directly business related. As I said, if mutual fund transaction happens in Q3, then Q4 the mutual fund part will go up. That's all. But capital will come in. So it's more arithmetic there. But trend of retail fees excellent.
Okay. Thanks and all the best. Yeah.
Thank you.
Thank you. The next question is from the line of Nischint Chawate from Kotak Securities. Please go ahead.
Hi. Thanks for the.
Hi, Nischint.
Hi. Just one clarification. This defocused book going down by almost 1,000 odd crores. This is all recoveries?
I wouldn't know. I think.
Okay, recoveries and sell down. I mean.
It is a part of it was part of that 1,000 crore ARCC. Little bit, but rest recover.
Sure. On the consumer loan side, if you could give some breakup in terms of how much was cross-sell and how much was sourced from digitally or from third party.
Okay. In the book, most of it will be cross-sell. In the book, almost 90%. I mean, I don't have the precise numbers. IR will give you, but in the book, most of it will be cross-sell. But in disbursements, now cross-sell is, I believe, around 60%. So as quarterly disbursements go ahead, cross-sell percentage comes down, and the other sources of sourcing through various partners, which I have been talking about, will increase, obviously. So first 2 years we did only cross-sell. That is why the book is majorly cross-sell.
So, and how much of this is salaried?
I don't have that breakup straight away available. Can we get that to you?
Sure, perfect. Those were my questions. Thank you very much.
See, in loyalty, the loyalty was on two-wheeler mostly. So it will be the same proportion. So almost 50% will be non-salaried in that loyalty.
They're tested.
But tested customers. So, and this I'm just answering out of common sense. I don't have a precise number with me right now. But since it was two-wheeler loyalty, it will be following the same pattern, right?
That's right. I just wanted a broad sense. Just on this, continuing further, now that you have moved your NPA to EAD, does it mean that your interest reversals would be lower and your NII probably will be less volatile?
No, it is only for that NPA reporting that, only for those numbers. Accounting was always on EAD basis. So in P&L, nothing changes. It was only representation of these numbers. We had taken a call not to change the numbers suddenly during the plan period. That's all. So if you see actually the published accounts were always on EAD basis. It is only in the investor presentation that we used to put the principal basis. So nothing has changed in accounting, so nothing will change in profit numbers, NII, nothing.
So, perfect. Thank you very much.
Thank you.
Thank you. The next question is from the line of Samir Bise from JM Financial. Please go ahead.
Hello.
Hi.
Yeah, hi. Thank you for the opportunity. Just wanted to, coming back to the consumer finance book, strong improvement in disbursements. Some sense on the quality of customer probably which is being onboarded. You said large part of the existing book is the erstwhile two-wheeler customers, but incrementally, any sense on what kind of bureau scores or credit profile are you looking at? And secondly, on SME finance also, how is the origination progressing in terms of strategy?
Okay.
Those are my two questions.
Okay, sure. So I will just use the words little more carefully, not erstwhile two-wheeler customers necessarily. There may be even existing two-wheeler customers, but tested two-wheeler customers. That they have a particular MOB, month on book with us, no bounces. We look at bounces more than what is called at the end of the month DPD. So those criteria are used, and because of that, the portfolio quality is excellent. Now, while we also started sourcing from outside over the last 1 year, credit matrices, analytics works many credit matrices, and based on that gives pre-approved offers to various prospects. This portfolio is about, I would say, 1 year old. Continuously we work on that to keep improving the credit metrics. Given the way zero DPD collections are trending on a 3,000 crore portfolio now, so it's not a small portfolio, and I'm not measuring NPS because often NPS come later. But even zero DPD is trending, which numbers are given in the investor presentation. I would be very happy about the portfolio quality. So that's your first question. SME, very clearly our sourcing is on two things. We are in SCP, that is self-employed professional. We are concentrating mainly on doctors and chartered accountants. And then self-employed non-professionals, which are small units, which we are concentrating on people. So I don't know the exact number, but whose income, whose top line and bottom line have not gone down by more than a particular percentage during COVID. So these two are the initial, large level filters that we have. And then of course there is a black box, a credit black box for saying, for actually choosing the credit. Very early right now, just pilot, but the pilot quality very good. We have sourced till now, what about
126. Yeah.
130 crores around. We have one account which is more than zero DPD. One account at this point of time. But I will not be very proud about it. I mean, 130 crores is what? Nothing, right? So, kya baat kare?
What rates are these being sourced at? Lending rates?
13-14%, something like that. Around 15 or 16%, something like that at this point.
SCP is slightly more.
And SCP is around 13%.
Okay. Those were my questions. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Shubhranshu Mishra from UBS Group. Please go ahead.
Hi, Shubhranshu.
Good morning, sir. Thank you for the opportunity. So the first one is on the consumer loans that we are targeting. We are saying that we roughly have a 2.5 lakh database. What kind of ticket sizes are we targeting here? And again, if it's an urban customer, my thought is that it's a hyper-competitive space. So what kind of Cat A, Cat B, Cat C customer proportions are we planning to put in here? Because if it's a Cat A customer, it's a hyper-competitive space and it's a super pampered customer. That's the first question around the consumer loans. The second is there's a particular line that you've written about the monetization of 7 crore plus customer database, which includes co-borrowers, guarantors, and prospects. So under the extant regulations, can we monetize the database of co-borrowers, guarantors, and prospects? I understand we can monetize the customer database, but can we monetize the co-borrowers, guarantors, and prospects and references database under the present?
Monetize ka meaning I hope you understood. Monetize doesn't mean sell the database. Monetize means use the data we have collected for making them offers.
Payment to customers.
So there is nothing to stop you from the data you have collected with, and we are not sharing data with anybody. Monetizing meaning we are not selling it. So the word should be leveraging, not monetizing. I'm sorry for using that. We are taking that database, which those people have given to us, putting it through our data analytics and making them pre-approved offers. And it is up to them whether to take that offer or not. So nobody is forcing them. So for example, suppose you have guaranteed somebody, we have your database. We will actually send you a link for downloading our app, or we will send you a link for clicking, SMS for clicking and going on to the app. When you download your app and you log in, then you will be automatically getting a pre-approved offer. That's what it was. Perfectly legal, compliance cleared, everything. So there is no problem there. Answering your first question. The average ticket size, we are not in the BNPL. We are not in the less than 50,000 category. You are absolutely right. There are categories, either the 10 lakh, 20 lakhs, which is the wealth customers, or the less than 50,000, which is absolutely hyper competitive. We are not there. We are not in BNPL. We are right now on two things, where we know the customer end use, or we know the customer repayment track record. The average tickets are between 1.5 to around 2 lakhs. That's the sweet spot. They are either our customers, and hence we go to them with pre-approved offers. Hence, obviously, stand a better chance of conversion than a competition. That if you want, you going to somebody, or you going on a website and applying, then getting processed, then getting the money, we give pre-approved offers. So that's one. Also, increasingly working on being on sites. So educational institutions, we will be on the site. Suppose you tomorrow go and take an admission, not you, but your younger brother or whoever takes in Alan or Akash, either our person will be there or our software will be there, that the fees, which are, are not cheap anymore, are you get funding from us. So it is competitive. I wouldn't say it is hyper competitive. Good players, there are 2 or 3. I wouldn't take names. And then there are plethora of fintechs. And the fintechs are there one day, not there another day, depending on the amount of funding they are getting from their funders. So reasonably good market, good companies have made good portfolios. More important here is not so much the issue of demand. More important is how you control credit quality, how are your credit matrices, and how you make sure that your portfolio suddenly doesn't deteriorate. So a lot of concentration is going there, and we are making sure that doesn't happen. That's why we are actually calling ourselves fintech at scale, that we will do all this, but do it in a way that at scale NBFC does. And not only for this, even for SME, there is no dearth of demand. I mean, you want to give a SME loan, there will be somebody to take it. Right? The important part is, one, how your product differentiates from others, the speed with which you give, and more importantly, the credit matrices and the early bucket collections that you have. Once you get all these right, you will build a good portfolio. So we are hoping to do all that. Hopefully you will be, perhaps having more confidence in our abilities in 2 or 3 quarters as we build it.
Just to clarify, sir, you said that we can make an offer to the co-borrower, guarantors, and prospects, as well as references under the present regulations. Have I understood correctly?
Sorry?
No, you said regulations. We can make an offer to co-borrower, guarantors, prospects, and references. Is that correct? Is that a correct understanding?
Yes, yes. Sure.
Sure. Thank you so much.
Thank you.
Thank you very much. I now hand the conference over to Mr. Dinanath Dubhashi for closing comments.
Oh, no, I mean, no closing comment. Only thing I would say that first quarter of a very exciting 16-quarter plan. Believe we have made a good progress. We will keep showing better and better results every quarter, counting on your confidence. Thank you.
Thank you very much. On behalf of L&T Finance Holdings Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
Yeah.
Thank you.